So Andrew, for the most part, we've really highlighted some of the very optimistic and kind of longer term growth opportunities within China, India, and the greater Asian economies. Perhaps you could shed just a quick light on some of the concerns that an investor might have around those markets.
Well, there are always concerns around valuations and stock market forecasts, but I wanted to show you one that's perhaps a little less visible to many investors today, and that is the very elevated assumptions for growth that are currently surrounding China. I've been working at Matthews since 1998, and for my entire career, people have whispered about a day that one day, very far off in the future, maybe in 2040 or 2050, where the Chinese economy, if it were lucky, might eclipse that of the U.S. in its size. Fast forwarding to the present, 2010, or excuse me, we're now 2011, there are now forecasts in the market, and I'm showing you one, that suggests that China's economy will grow from its $5.8 trillion size today to approximately $23 trillion in a decade's time, and in so doing, it will eclipse the U.S. The assumptions that drive that forecast in terms of growth, inflation, and currency-related gains are presented in the bottom table. I'm showing you this because, not because I believe it, but rather the opposite. I would suggest to you that the sort of forecasts that are in this table are quite elevated and are beginning to stretch the fabric of possibility in China. China has grown at a very rapid rate over the last decade because it was growing from a very small base. It was growing from a very, very small economy around 1 to 2 trillion in size. So to achieve something larger was quite possible. But today, its ability to continue to compound at such high rates of growth stretch credibility, and I would suggest that investors moderate their expectations and do not sort of fall prey to the sort of thinking that this table represents. I still am very positive about long-term growth prospects for China. I don't wish to dissuade you from those, but rather just to have moderate expectations, not like those that are embodied in this table. With that, I'd like to thank the audience again for participating today. And again, we are going to wrap up with some questions and answers after Dana has some comments.
Thank you so much, Andrew. This has been fascinating, and I know Andrew and we really covered a great deal of information in a relatively short period of time. I'd like to just highlight a few things for all of us before we move on to Q&A, and that is all of these webinars, as always, are recorded. So for folks that weren't able to attend today, there will be a recorded version. Past webinars are available on our website at bellinvest.com, and in the next 3 months, we've got a host of exciting webinars, including things such as investing in gold and building momentum through financial planning. So now we will go ahead and move forward to the Q&A section. Again, you can submit your questions using the upper right-hand corner GoToMeeting control box, and we will go ahead and start in just a moment here. Great. We've got a first question that did come in. Andrew, is there concern over China's large and growing loans that have fallen into non-performing status?
Just to give the audience some quick background as to that question, and I thank you for it. During 2008, during a period of very substantial weakness of the global economy, many of the Chinese banks, at the behest of the government, which does have controlling interest in those same banks, made a very substantial effort to grow their lending to the domestic Chinese economy. And in so doing, they sought to avoid any liquidity-related crises and to help companies have enough finance to see them through that downturn. What the question refers to, though, is that those loans are beginning to come due this year and the next, and there are some concerns that that some of those loans were poorly made, hastily made, and will begin to sour this year. I, too, share some of those concerns, and you'll notice that Matthews tends to shy away from substantial investments in the domestic Chinese banking sector, despite its very vast size, because we still have concerns that the banks are not necessarily run for the most commercial interests and tend to instead be used for political and policy-related purposes by the central government. However, I've been following the sector for a decade, and I can say it's vastly improved, vastly better capitalized, and in fact has proactively recapitalized itself in the last few years so as to deal with any forthcoming issues that may arise from this spurt of loan growth that the banks have gone through. So I think that at this juncture the banks may be in for some trouble, but I don't see it as the sort of trouble that could swamp the system as we saw it happen here in 2008.
And we've got another question that just came in. How do you view the current equity valuations in Asia?
The valuations in Asia today, I don't believe are incredibly attractive, but they are not unworkable for patient long-term investors either. Forward price-to-earnings multiples in markets stand at around 13 times 2011 earnings forecasts, which is not out of line with history or long-term averages. The only concern, in fact, it's a fairly attractive valuation figure from my perspective, except that it's predicated on still fairly aggressive growth assumptions. The market forecasts that analysts have built in order to achieve that statistic are fairly elevated in my view, and I worry that we won't necessarily achieve the elevated growth rates that some have forecast. And in that sense, as the market begins to wake up to that concern, there may be a little bit of concern about valuations being elevated.
And another question that came in here, Andrew, is how do you compare and contrast the relative opportunities between China and India in particular?
It's a great question. I think the most important thing to note, despite these both being emerging markets in investor parlance, there couldn't be a wider gap in terms of these economies being at different stages of their growth. India is still at a fairly nascent stage and really needing to expand its investment in especially physical infrastructure such as roadways, bridges, ports, other transportation linkages, and even its development of residential and commercial property. Meanwhile, China has gone through the better part of its growth in that regard and really needs to begin to focus on some of the more productive and efficient sources of growth that would arise from especially the services sector that we discussed. China's major investments in its infrastructure are largely behind it, with some key exceptions, and we need to see this economy move to a different tier of growth, and it's very different from what India is experiencing.
I think we have time for one more quick question, and it's around inflation. Is inflation becoming a challenge or a risk to China or some of the other Asian markets right now?
It most certainly is, and I think that forecasters have been too calm or too ignorant in looking forward in terms of the sort of inflationary pressures that might emerge from the region. Most are attributing the inflationary pressures that are impacting China and India right now to short-term supply shocks for food, perhaps bad harvests related to weather and whatnot. I think those are short-term factors impacting inflation, but I think we are going to see longer-term inflation around calories and consumption in Asia, because as people are growing wealthier, the very nature of their diets is changing, and it is leading to greater demand and greater consumption for food, which is tending to skew inflationary measures in Asia much higher. And I'm concerned this will prevail for quite some time, and that Asian central banks, in order to get ahead of the problem, will be raising interest rates for some time.
Wonderful. I'd like to just conclude by reminding everyone to please fill out the survey that will be sent to you in the next hour or so. We always appreciate your feedback. In particular, today's webinar was a bit unique. I think it was very robust, and I'd like to again thank Andrew Foster and the folks at Matthews International Capital Group for their time and effort today. And as always, if you didn't get your question answered, we will circle back with you one-on-one. And if you think of a question after the fact, please don't hesitate to get in touch with us. Thank you, everyone, for joining us today, and have a wonderful afternoon.